Imagine a small group of economists quietly deciding a number that changes the price of your coffee, your mortgage, and even your job prospects. That's the power of central banks and their interest rates. This tiny percentage is the price of borrowing money, shaping everything from car loans to national growth. If you borrow, it's the extra you pay back. If you save, it's your reward for letting the bank use your money. Central banks like the US Federal Reserve or the European Central Bank set a base rate, which acts as the foundation for all other rates. These rates are always moving. For instance, at the time of publishing this video, central banks raised rates to fight inflation when your money buys less over time. The tide was turning. The ECB and Bank of England made their first cuts in years, trying to balance stable prices with economic growth. Meanwhile, the US was holding steady, and countries like Brazil were raising rates to cool their economies. Each move tells a story about a country's economic health and future hopes. Understanding why rates change helps you decode the headlines and your own wallet. This number isn't just economic trivia, it's the key to understanding the forces shaping your daily life. Central bankers aren't guessing when they set rates, and they're analysing 5 key economic signals. First, inflation. If prices rise too fast, rates go up to cool spending. If inflation is too low, rates drop to encourage borrowing. Second, economic growth measured by GDP. Too much growth risks overheating. Too little and rates are cut to spark activity. Third, the labour market. Low unemployment can push wages and prices up, prompting rate hikes. Weak job markets may trigger cuts. Fourth, consumer spending. Are people buying or saving? Strong spending can mean higher rates to prevent overheating. Fifth, business confidence. Are companies investing or holding back? High confidence can support rate hikes. Low confidence may call for cuts. Central banks juggle these ingredients, aiming for stability. It's a constant balancing act. Too much or too little of any ingredient, and the whole economic recipe can go wrong. And that's why every rate decision is a careful response to a complex mix of signals. The next time you hear about a rate change, remember it's not random. It's a recipe crafted from these 5 crucial clues. And just like a chef, central bankers adjust the mix to keep the economy healthy. Get the recipe wrong and everyone feels it. Get it right and the economy hums along. The US Federal Reserve and the European Central Bank both steer their economies, but with different priorities. The Fed's dual mandate: keep prices stable and maximise employment. It's a balancing act. Too much focus on one and the other can suffer. The Fed's committee meets 8 times a year, and at the time they were holding rates high, waiting for clear signs that inflation is under control. The ECB, meanwhile, has a single top priority: price stability across the Eurozone's diverse economies. This month, the ECB cut rates for the first time in years as inflation cooled and growth slowed. The challenge? One rate must fit 20 countries, from booming Germany to struggling Italy. Every decision is a compromise, but both banks shape the global economy with every move. Why can't we just borrow money for free? Because interest is the engine that keeps the financial world running. Lenders take risks, like not getting paid back, and give up the chance to use their money elsewhere. Interest compensates them for these risks and for waiting. The higher the risk, the higher the interest rate. Inflation matters too. If prices rise, lenders want to make sure the money they get back is worth as much as what they lent. That's why interest rates are usually higher than inflation. There's also opportunity cost. Lenders could have spent or invested that money instead. Interest is their reward for waiting and foregoing other opportunities. So this basic principle, valuing today's money more than tomorrow's, underpins the entire system. Without interest, there'd be little incentive to save or lend, and the flow of credit would dry up. Interest is what keeps the wheels of the economy turning. Why do we value money now more than money later? Austrian economist Böhm Bawerk said it's simple: we're impatient. We want things now, not later, and the future is uncertain. That's why lenders need compensation, interest to delay gratification. Irving added another layer: opportunity. Money isn't just for spending. It can be invested to create more money. Borrowers want funds to seize opportunities, while savers need a reason to wait. The interest rate balances these forces. It must be high enough to tempt savers, but low enough for borrowers to profit. It's the bridge between impatience and opportunity. This balance lets capital flow to where it's most productive. That's why interest is the price that connects today's desires with tomorrow's possibilities. When the central bank cuts rates, your mortgage doesn't always drop overnight. The base rate is just the starting point, like flour in a bakery. Banks add layers, their own funding costs, inflation expectations, and your personal risk. If banks expect inflation to stay high, long-term rates like mortgages may not fall, even if the central bank cuts. Your credit score, income, and job stability all affect the final rate you're offered. Low-risk borrowers get better deals. Higher risk means higher rates. That's why two people can get very different rates from the same bank on the same day. The process is complex, but it all starts with that central bank number. Every layer adds cost, risk, or reward. Understanding this helps you make smarter borrowing decisions. Interest rates aren't just headlines, they shape your daily life. When rates fall, borrowing gets cheaper, fueling home buying and business growth. High rates do the opposite. They reward saving and slow down spending to fight inflation. Knowing how rates work helps you make better choices, like when to refinance or pay off debt. It explains why your savings earn little, or why loans cost more. The story of interest rates is about balance, today's needs versus tomorrow's, growth versus stability. As central banks navigate the post-pandemic world, their decisions ripple through your finances. Understanding the why behind the moves makes you an empowered, informed citizen.